There's a financial market out there worth somewhere between 140 and $300 trillion, and it affects the stock market, your mortgage, government debt, and even crypto. And that market is bonds. And yet most people have no idea what bonds are or why they should even care. But every time interest rates jump or home prices fall or companies start laying people off, this market is usually the reason. So let's start with what a bond actually is. A bond is just a loan. When you buy a bond, you're lending money to someone, usually the government or a corporation, and they promise to pay you back with interest. And that interest is referred to as yield. The US government issues bonds called Treasury bonds, and they range from 1-month Treasury bills to 30-year Treasury bonds. Now, one of the key parts to understanding bonds is that bond prices and yields move in opposite directions. When bond prices go up, yields or the interest you're getting paid on the bond go down. And when bond prices fall, yields rise. So let's say you buy a $1,000 Treasury bond, and that pays you 4% interest per year. That's about $40 a year. 6 months later, you want to sell it, but the Treasury is now issuing new bonds that pay 5%. So your bond is suddenly less attractive. No one wants to pay $1,000 for a bond earning 4% when they can get 5% directly from the government. So you have to lower your price. Maybe you sell it for $900 instead. So the interest payment stays the same. It's still only $40 a year, but now the buyer only paid $900 for it. So it's the same $40, but a lower price they're paying. That means that their return just went up. So the bond's price went down and the interest you're getting on it or the yield went up. That inverse relationship is the foundation of how the bond market works. So why does the US government's bond market affect every other market in the world? It's because US Treasury bonds are considered the safest investment in the world. The US government is big, stable, and reliable. In a worst case scenario, they can print money to pay off its debts. That doesn't mean it's consequence-free. Printing money does cause inflation, but it means the risk of outright default is extremely low. Every other type of borrower in the economy, states, cities, corporations, banks, people, is much riskier than the US government. So their interest rates are always higher than the government's. If the federal government's interest rates rise, everyone else's rates rise too, because investors compare everything to treasuries. If a bank can get 5% from a risk-free government bond, why would they accept 4% from a corporation that can't even print money to pay off its debts? They don't. The corporation has to offer more than 5% to make it worth the risk. This is why the 10-year Treasury yield is the most watched number in finance. It's the benchmark for everything. Everything in finance, including your mortgage, your car loan, corporate debt, is all benchmarked to the 10-year Treasury bond. When the 10-year Treasury yield moves, it affects the cost of borrowing for everyone in the economy. Now let's talk about how this actually affects the broader economy. We learned earlier that when Treasury yields rise, the cost of borrowing goes up for everyone, including businesses. And businesses are constantly issuing debt to raise money to grow. Maybe they're building a new factory. Maybe they're acquiring another company. Maybe they're just refinancing existing debt. Whatever the reason, they have to pay interest rates that are competitive with Treasury bonds. If the 10-year Treasury is at 2%, a solid corporation might be able to borrow at 3 or 4%. But if the 10-year Treasury jumps to 5%, that same corporation has to pay 6 or 7%. That might not sound like a huge difference, but when you're borrowing billions of dollars, a 2% increase in interest rates means hundreds of millions of dollars in extra costs every year. So what do companies do when Treasury bonds are high? They borrow less, they delay expansions, they cut costs, and sometimes they lay people off. So that means that higher bond yields actually slow down business investment, and that in turn slows down economic growth. And that directly affects jobs. And it's not just big corporations. Small businesses that rely on loans to expand face the exact same problem. Higher Treasury yields mean higher borrowing costs across the board. And this is one of the main ways that the bond market controls the pace of the entire economy. So what makes bond prices move? There are 3 main things. The first is investor confidence. When people think the economy is stable and the government's finances are healthy, they want to buy Treasury bonds. And high demand for government debt means the government doesn't have to offer a lot of interest to attract buyers. So you start to see bond prices go up and the yields go down. On the opposite end, when people lose confidence in the economy, maybe they're worried about inflation or government debt getting too high or a recession, they sell bonds. So you start to see prices fall and the yields rise. The second thing that affects bond prices is inflation expectations. If investors think inflation is going to be high, they demand a higher return or yield on their money to compensate. Because if they lend the government money at 3% and inflation is 4%, they're losing money. So you start to see a sell-off in bonds. And remember, when bond prices go down, yields go up, even if the Fed hasn't done anything yet. And the third thing that affects bond prices is government borrowing. When the government runs big deficits and issues a ton of new debt, that increases the supply of bonds in the market. And more supply means lower prices, and lower prices means higher yields. This is happening right now. The US government ran a $1.8 trillion deficit last year. To cover that, they had to issue new bonds, and they had to issue a lot of them. And when there's a flood of new bonds hitting the market, investors can be pickier and they can demand higher yields. So more government debt doesn't just increase the amount the government has to pay in interest, it pushes up yields across the entire economy, affecting mortgages, car loans, business loans, everything. So why isn't this common knowledge? Why don't more people understand this? It's because the bond market is invisible. You don't see prices scrolling across the bottom of CNBC every day. There's no Dow Jones of bonds that people check obsessively. The bond market is traded over the counter, meaning private transactions between brokers and dealers, not on a public exchange where prices are posted in real time. So most people, they have no idea what's happening in the bond market until it shows up somewhere else, like in their mortgage rate or in layoff announcements or in government budget cuts. But by then, the cause and effect is so disconnected that no one makes that connection. You don't think bond yields rose, so my mortgage got more expensive. You just think mortgage rates are high, I guess the Fed is doing something. But the Fed isn't always the reason. Sometimes it's fiscal policy, sometimes it's inflation expectations, and sometimes it's just supply and demand in the bond market. The bond market is the invisible infrastructure of the entire economy, and it's bigger and more powerful than the stock market that most people obsess over. And when you hear that bond prices are falling, you know investors are getting nervous about something. Maybe inflation, maybe government debt, or maybe a recession. And now that you understand the importance of bonds, you can make more informed financial decisions.